case that you need to remember that the assessor values the property as at July 1st of the previous year. And they're using a strange phrase, as at, but it's basically the property's value that the assessor comes to is from the previous year on July 1st. So as of July 1st on the previous year. And why is that the case? Because the assessor needs to get their job done so that the assessment notices can be mailed out to owners at the end of the year. And so they've got to get on that job and get it finished and completed so all the paperwork can be done and all of those notices can be sent out. So the assessment notice is how that's done. It's an extract from the assessment roll. It informs the property owner of the actual value of his property. So like I said, when the assessor gets that number, when they finally decide on a number of value for a property, then the assessment notice is what allows owners to understand what the assessor has done. Okay. Now, it's an extract from the assessment roll. What does that mean? So the assessment roll is the large report that's done that has all of the details about a property. And the owners typically don't care about all of those details in the property. They just care about what is my value, what are my tax obligations. So just give it to me straight, give it to me in a short, sweet, little tiny document, couple pages. That's what your assessment notice is. So when we say it's an extract, we think of it as you're pulling something out. It's a little tiny piece. It's a condensed version. So if you like to bake things, then a lot of people use vanilla extract for their baking. What is that? Vanilla extract is a super concentrated form of vanilla where you only need to add a couple of drops in order to have the whole thing flavored with vanilla. Okay, so the extract from the assessment roll is just a tiny little part. It's a condensed down, boiled down version of exactly what that owner needs to know. So it gives the owner the idea of what the actual value of their property is. Now, these assessment notices are mailed to owners at the end of December, so owners will receive them sometime in January. And we also have the tax notice that is sent out in the springtime. So after the assessment notices are mailed out and owners get those in January, then a tax notice gets sent out in the springtime, and that's the request for the payment where the government is putting their hand out and saying, give me my money. So that is sort of the progression of how it happens, right? The assessor makes their decisions. They go and consider all the things. They come up with that assessed value. They do that larger report of the assessment roll. Then that assessment notice, that boiled down information, just what's pertinent for the owner, is taken out. And that assessment notice is sent to the owners at the end of December. They get them in January. And then later, the tax bill, right? That tax notice comes in the mail in the springtime. That's sent out. Okay, so that kind of gives you the whole idea of what the government goes through in order to get more money from you out of your bank accounts every year. Okay, so when will BC Assessment mail assessment notices to property owners? They will mail them at the end of December. It is January 6th, and Mike has just received an assessment notice on her home. The assessed value of the property is shown as $600,000, which represents the value of the property as at when. So remember that phrase, as at, means when was the property valued? What point in time was it valued? It was as at July 1st of the previous year. Okay, you're paying for those taxes in this year, but the property's value that you're basing those taxes on was the previous year in July 1st. Which one of the following statements best describes the difference between an assessment notice and a tax notice? So that's why the definitions are really important, because you get these simple questions. So this one's a super easy one. Number one, a tax notice is a request for payment and an assessment notice isn't. So what was that assessment notice, right? What was the purpose of it? That gave the owners their actual value of the property. That was what helped them understand what they needed to pay taxes on. So both notices are not requests for payment. The tax notice doesn't provide a breakdown of the tax systems. That's done in your assessment notice. Neither statement is a request for payment, so the tax notice is, so that's why that's false. And they both inform the owner of the assessed value of the property. No, actually, the assessment notice informs the owner of their actual value of the property. And an assessment notice is used to supplement the assessment roll. So it's not used to supplement, it's not put in addition to the assessment roll. It's actually a tiny little piece from that assessment roll. So super, super easy. When you know all the details, you can easily reason through all of those answer choices. This is what you need to be doing with all of your questions, because it doesn't matter how they change this question on you, what they ask for based on this info, you'll still be able to do that reasoning and come up with the correct answer. So you have this grid on your notes. This is to help you tell the difference between an assessment appraisal and a private fee appraisal. So what is the difference? The assessor is the one who works for the government, and it's particularly for taxation purposes. Private fee appraisals are done by appraisers, and that's for all kinds of different reasons, right? Lending or for evaluations by real estate licensees, that kind of thing. So how do you tell the difference between the two? There are four main sort of characteristics for each, and they kind of compare both of them. The top two are the most important, so I'm going to cover those last. The assessors, because they work for the government, they have access to the data for all of the transactions in the land title office. So automatically, they don't have to ask for anything or try to find out anything. They just have all of that information at their fingertips. Whereas the private fee appraisals, so those appraisers that do it, they don't have that access, right? That carte blanche access. They may not be able to look at all of the transactions or find information on all of the transactions. The other thing is that the assessors can't adjust estimates of value to reflect a tenant's interest, whereas the private fee appraisals, they can. So they can choose whether they want to. Private fee appraisals are a little bit more flexible because there's an ability to decide what is relevant to that situation and to that appraisal and what isn't. Whereas the assessor, they have to evaluate and put a value on anything and everything because it's for taxation purposes. Okay. The top two, like I said, are the most important. So the assessors are constrained to certain dates. We said that they need to get their job done by a particular timing so that all of those notices can go out at the proper times. And they have to value all interest in land. Like I said, they've got to do that because it's for taxation purposes, right? The government wants every single penny that you owe them. Whereas the private fee appraisals, the people doing those, they're a little bit more flexible. They can choose what they want to evaluate and what they want to include based on what's relevant for that situation. Okay. The last thing I want to mention about this is be careful about the language that you kind of get stuck in your head. So assessor is safe, right? That's a safe title. Appraiser, yes, it's true. And that's what we call the people who do these private fee appraisals. But because it's called an assessment appraisal and a private fee appraisal, if you get that appraiser word stuck in your head, then you might get confused between which one's which, right? Because they both use that same root word. So just make sure that you don't get confused on that and you know the difference and who it is that they're talking about based on those descriptions. Okay, what is the primary difference between an assessment appraisal and a private fee appraisal? So like I said, the most important ones, and usually what they're trying to get you to answer as the answer choice, is that the assessor is constrained to certain dates and must value all interest in land. So always look for that one first, and then make sure that you check all of the other answer choices as well to make sure that you haven't missed something. So number one says the private fee appraiser has access to all data for all property transactions as reported by the Land Title Office, whereas the assessor does not. That is the exact opposite. The assessor is the one that has the access to the Land Title Office, and the private fee appraisers don't necessarily have access to everything, even though they could access some. The assessor would normally have an estimate of value to reflect a tenant's interest, whereas the private fee appraiser does not. And again, that's exactly the same as number one. It's the opposite. Okay, so they put it on there backwards for you. Number three says the private fee appraiser looks at the market for the various indicators of value, whereas the assessor does not. This one is false because both of them would actually look at the market to determine value. And number four is our true answer choice, like we said before. That's the one that you should try and look for first. And if you can't find it, then you're forced to go through all the answer choices to figure out which one is the answer that they're looking for. Okay, so this one, just make sure that you check all the other ones. If you see this one, make sure you check all of those other answer choices before you just choose it and move on. So how do you get relief or an exemption from property taxes? Think of the top three as government entities. So properties owned by the Crown, municipal properties, and universities, colleges, and schools. So those are all, I mean, I know they can be privately owned, but they are exempt from property taxation. So think of it this way. If these are all government entities, does it make sense that they would bother to waste their time to do the paperwork and pay themselves taxes? They can just give themselves an exemption, and it makes things a lot easier for everybody involved. Churches, they're also exempt. So the top four, they can get those exemptions. The next four, cemeteries, farms, forest land, and golf courses, they can get relief from taxation. Even though they're businesses, they can still get relief from taxation. So when you think about all of these types of businesses, their square footage of their property is large, right? They're cemeteries and farms and forest land and those golf courses, they've got a lot of square footage for those properties. And so the way that they get relief is that their properties can be assessed differently so that they get relief in the form of paying less taxes. So we say that they're under assessed so that they don't pay as much taxes. And that's how they get relief. They're not exempt. They just get a break on those taxes. Homeowner grant is another way that regular citizens, all of us regular Joes, can get that relief from taxation. So again, we're not exempt. We still have to pay, but we can get a break. We can get sort of a discount on it. Now, there's exemptions. Those top four, they are available as long as those entities are not profiting. If any of them are profiting, including the government entities that are listed, if they're profiting, then they would need to pay taxes. They don't get to benefit from that exemption anymore. Okay, so which would be fully exempt from taxation? Martland, BC has recently built a new City Hall building. The former City Hall is still owned by the municipality, but is now rented out and operates as a profitable art gallery. So would they be exempt from taxation? No, they wouldn't, because it says in the answer choice that it's rented out and now is operating profitably as an art gallery. So they're making a profit, they're not exempt. A church is located on a 1-acre parcel of land in Prince George, BC. The church has built a multifamily dwelling on a portion of the site to provide additional revenue. So again, a revenue means they're profiting. So churches would normally be exempt, but in this case, they're not exempt because they're making that profit. A university that permits community groups to use its playing fields during the summer, would they be exempt from taxation? So you might not be sure of the use of the fields. So skip to 4, we'll check that one. All owner-occupiers who earn less than $12,000 a year gross income, even if you don't earn much, you're not exempt from taxation. So number 3 is where they would be exempt, fully exempt. So for this one here, they're just saying that they're letting people use the summer, or use the fields in the summer. They're not charging a fee for it. They're not collecting any cash for it. They're just letting other groups to use it. So that one would be fully exempt. Now for the details on the homeowner's grant, for this one, only the owner-occupier of a property can claim this homeowner's grant. So if you own 5 properties, there's only one of those properties that you can get the homeowner's grant on, because you can only live in one property at a time. Okay, so homeowners for owner occupiers. And you see on this slide here, we've got the column A with no grant, column B with basic grant, and column C with additional grant. So no grant is where you pay the maximum amount. There's no breaks when you fall into that category. Generally, it's businesses, right? They don't get a break on their property taxes. The basic grant in column B, that's for our homeowner grant. So if you are the owner occupier of a property, then you can get a little bit of a break on your property taxes every year. So and you can see that if you do the math here, you probably can't see the numbers, but it's $2,060.07 as opposed to $1,490.07 for the column B. And if you do the subtraction on that, then you get $570 as a grant, like as a break on that taxes. So that's for the city of Vancouver. That's what this one is for. This assessment is for Vancouver. If you're outside in certain other areas in the Fraser Valley, so $570 for Metro Vancouver, Fraser Valley, and Capital Regional Districts, and then it's $770 for properties that are in northern and rural areas. So outside of that, okay, so $570 or $770. There is an additional grant category here as well in category C, and that's if you meet certain criteria. So anybody can claim the basic grant in column B, but you have to meet certain criteria in order to take advantage of column C for that additional grant, and that can be based on being, a senior or a veteran or persons with disabilities. Okay, so know the details for those. Pretty easy. Most of us really know all about property taxes because we've paid them a time or two. So who may claim a homeowner grant? If you remember, it has to be the owner occupier of the property. So it's not anybody whose name appears on the assessment roll, because there could be a name there by accident, right? It could be an error. And if you said that person was able to claim the homeowner grant, then they may not be, because that name might not be there, or maybe shouldn't be there. The tenant of a property, if he has a lease exceeding 3 years, so no tenants, they don't pay taxes in the first place, and the owner of a property, whether he lives there or not. So it has to be the owner occupier of that property. So when you're renting out a property, if you own a property and you're not living there, it's not your primary residence, then you pay that no grant, right? Full amount of taxes. You can defer your taxes as well if you meet some criteria that we're going to talk about here. So if you are a widower or a widow, which means your spouse has died. Okay, so widow is a female who had their male spouse die, and widower is a male spouse that had their female spouse die. So widow or widower, if you're 55 years or older, if you're permanently disabled, then you can ask to have your taxes deferred. So in order for you to request to have your taxes deferred, you have to meet the criteria at the bottom here first. You have to be a Canadian citizen landed immigrant, you have to have lived in BC for a year, and you have to own a certain percent of equity in your property. For the top three, it is 25% equity, right? The government wants to make sure that they can put their hand out and collect from you, because they want to collect that taxes from you eventually. It's just a deferral, which means you put it off until later, but you still have to pay it. So you pay when you either sell the property or when you die and your estate gets rid of that property. And you don't just pay for the taxes that you've deferred, you pay for interest as well, because the government's nice, but they're not that nice. Okay, the last one is for where the parents are financially supporting a child. And for that one, it's the same criteria, except the difference is you have to own 15% equity in the property instead of the 25. So same deal, you have to be Canadian citizen, landed immigrant, you have to have lived in BC for 1 year, and you have to you have to own 15% equity in that property. So the top three are the regular program. That's what it's called. It's the regular program. And then the bottom one is the financially supporting a child program. So we defer those taxes. The province pays them on our behalf. And then that's why we have to pay the province back, and we pay them interest for whatever time frame that we've deferred those taxes. So when those taxes are deferred, then the province will pay them, and it actually shows up as an arrangement on the title. So it's on the title as a registered charge. And so people know when they pull title, they can know that you've deferred your taxes, and they know that you need to get that taken care of before you can actually pass title on to someone who would purchase. Okay, so it has to be all taken care of before you can transfer that title. So that's the reason why you're learning about this stuff, right? Not just to see how much the government gouges you for taxes, but that's interesting too. What would make a property owner eligible to apply for deferral of real property taxes? So if they're a war veteran, if they are 55 years of age or older, so hopefully you remember that is the one that would let them be qualify for that tax deferral. So war veteran, don't assume that they're old. Don't assume that they are permanently disabled. Okay, so that you could have a 25-year-old war veteran who's perfectly whole, and there's nothing wrong with them physically or mentally. Okay. Number three, property owner has declared bankruptcy within 12 months of the application. Too bad, so sad. You still owe your taxes, and the property owner is a member of parliament. We don't care. They still owe their taxes as well. So who can appeal? Who can appeal the amount of property taxes that you would need to pay or that they would need to pay? Anyone, pretty much. So if you have somebody that, if you remember, I mentioned earlier about names improperly being on the assessment roll. So anyone can make a complaint against the assessment roll for a number of different things. So you can't actually dispute your property taxes, but you can appeal the information that is on the assessment roll itself. So you can dispute when a name of a person has been wrongfully included or not included, omitted from the roll. When a property has been wrongfully included or omitted from the roll, so not just the name of persons, but the property itself may have been omitted from the roll or included when it shouldn't be. When a property is valued too high or too low an amount, then that means that you're not actually being charged the correct amount of taxes because your taxable value is incorrect. And then when an exemption has been improperly allowed or disallowed. So again, those are all of the reasons why somebody might want to appeal the property taxes. So you need to know that a property owner cannot appeal property taxes, but they can appeal the property assessments. So they can appeal the tax assessment and the assessment roll, but they cannot appeal the property taxes themselves. So who can appeal? An elderly couple with no children at home, they want to refuse to pay the school tax. So can you appeal and deny and refuse to pay those school taxes? No, you have to pay them. You can dispute the assessment roll and the assessment notice. What about a farmer who thinks his taxes are not valid according to his property zoning? So yes, that would be one of the options that he could appeal. A neighbor who thinks that her next door neighbor doesn't pay enough taxes since the neighbor's property was rezoned from agricultural zoning to commercial zoning. So that one would be another one where you could appeal. And a man who thinks taxes shouldn't be charged and are not valid. So you can't actually appeal or dispute the taxes themselves. You need to dispute the information and appeal the information that is on the assessment notice and assessment roll. Okay, so the two in the middle, B and C, could appeal. A and D are not able to. Speaking of the appeal process, you need to know how that goes. So you need to know where you start and where you might end if you continue to take that appeal process all the way to the top. So we start at the Property Assessment Review Panel. If you don't like the decision that you get there, then you take it up to the Property Assessment Appeal Board. If you don't like the decision from that level, then you go to the Supreme Court of BC. And if you don't like the decision from the Supreme Court of BC, then you could go to the BC Court of Appeal. In very, very rare cases, you might be able to go to the Supreme Court of Canada as a final stop at the bottom, but that would be something that would be significant nationally. It would have to have impact on the nation for you to be able to do that. So it's very rare and it doesn't really happen very often. So these are the four that you need to remember. How do you remember all of these and in this order? You think of peanut butter sandwich allergy. Lots of people do have peanut allergies these days, especially most people's kids. And so if you think of PDSA, that's P for panel, B for board, S for supreme, and A for appeal. Now you see that there's some dates and timings that are also included with this progress here through all of these levels. And so by January 31st, you need to have your appeal into the panel by that date. Then if you want to continue on and take it to the board, you have to have your documentation and your appeal in to the board by April 30th. If you want to continue on and go to the Supreme Court of BC, then you have to have all of your stuff submitted and into the Supreme Court of BC within 21 days of the board's decision. So the board might take some time, right? You have to have everything in by April 30th, but they're going to review your appeal, and then they might take some time to actually make their decision. It's within 21 days of that board's decision that you would need to get everything into the Supreme Court of BC. And then from the Supreme Court of BC's decision to take it up with the Court of Appeal, the BC Court of Appeal, you would need to do that within 30 days of that Supreme Court of BC decision, okay? And you remember that the highest court in BC is our BC Court of Appeal, not the BC Supreme Court, okay? It's the BC Court of Appeal. So when can appeal be made to a Supreme Court of BC regarding a real property assessment value? So you remember your PDSA, right? If we want to go to the Supreme Court, that means we have to have been to the board first. So you look for the answers that have board in them, and you see that in this list, only number 4 has that, so that must be the answer. And in fact, it is within 21 days of an appeal board decision. Okay, so 21 days of that board's decision there. So easy peasy, right? Pretty simple, straightforward stuff. An appeal on a point of law regarding a real property assessment value can be made from the Property Assessment Appeal Board directly to where? So again, you need to remember your PDSA, right? The order of those levels. If we want to go from the board, where do we go next? We go to that Supreme Court of BC. They've rearranged it to say BC Supreme Court. It means the same thing. Okay, so we're almost there. We just have the 2 last taxes. They're pretty quick. There's a few details, but not nearly as much as we covered with the property tax topic. So the speculation and vacancy tax is the one we're going to do next. It's SVT, and then we're going to do that empty home tax. I just want to take a second here to point out that they are 2 different taxes. They are not the same thing. They're not related. You could be subject to both of them. Okay, so they're not the same. Make sure that you know that, because a lot of people get them jumbled up and get them confused and think they're exactly the same tax, but they're not. Okay, so the SVT is an annual tax that is payable by any registered owner or co-owner of residential property. Okay, so that's key. Any registered owner. It could be foreign owners, it could be domestic owners that live here, or it could be Canadians who are non-residents. So anybody could be subject to this SVT. So that's the first thing. And the point of it is to curb property speculation, right? So speculation and vacancy tax, we don't want properties to be vacant. We want properties to have people and families living in them. And when we have vacant properties, it causes problems with people being able to try and find places to live. So our vacancy rates go super low, and then we don't have the ability to have new people move into our neighborhoods and our communities and cities. So it is payable by any registered owner that is the owner of residential property located in these designated taxable regions of BC, unless they qualify for an exemption. So it's an annual tax. You have to complete an annual declaration, and every single owner needs to complete their annual declaration. So if there's 5 people entitled, then 5 of these declarations need to be completed. It applies to residential property, not commercial property. So only residential property in the specific taxable areas of BC. You can claim exemptions to not pay it at all, or you can get tax credits if you end up that you are subject to it and you do need to pay it. Okay, So what is the deal with this one? What is the amount? If you do have to pay, and it really depends on who you are, how much you pay. So if you are considered to be a foreign owner or a satellite family, then you would pay 2% of the assessed value. And if you are a Canadian citizen or permanent resident of Canada and you're not part of the satellite family description, then you would pay 0.5%, 0.5% of the assessed value. So which of the following statements regarding the speculation and vacancy tax is true? So the SVT is applicable to all owners of residential and commercial property located in designated taxable regions of BC. So hopefully you know that this one is false because it says it's applicable to all owners of residential and commercial. So not all owners and not commercial property. So those are false. All owners of residential property located in designated taxable regions of BC must pay the SVT, and there are no exemptions. So that is false. There are exemptions. In order to claim an exemption from SVT, an owner must be eligible for full or partial tax credits. So if we go back here quickly, it said here you can claim an exemption or get tax credits. It's not a both situation. If you're exempt, then you wouldn't need to get the tax credits. So you don't have to be eligible for tax credits to get the exemption. So that one's false as well. And the SVT is payable by owners of residential property located in designated taxable regions of BC unless the owner qualifies for an exemption. So what is the deal with that satellite family phrase? What does that mean? Because that's a weird one, right? So what is a satellite family? This is an individual. So an individual is considered, could be considered a family as well. So it's either an individual or a spousal unit that declares less than 50% of their total combined household income for the year on Canadian tax returns. So if you're making 60% or 70% or 52% of your money elsewhere out of the country and you're not claiming it on a tax return, then you are considered to be a satellite family. So let's give you a couple of examples here with this little family. So we have a spousal unit here and we have them have two children. So for this first situation, the number one spouse, they're a Canadian citizen, but they're not the owner of the property that is going to be taxed. The number two spouse, they're not a Canadian citizen, but they do own the property. In this situation, this whole spousal unit, both spouses would be considered to be a satellite family because the number two spouse is earning the majority of the money and he's earning most of it outside the country. So 70% of their combined worldwide income is earned outside of Canada and is not reported on Canadian income tax returns. So I just want to go back quickly. When you declare less than 50% on a Canadian tax return, then you're considered a satellite family. For this one, it would be 30% that's claimed on the Canadian tax return, and that's why they're considered to be a satellite family, because they earn 70% elsewhere in the world. Okay, hopefully that makes it clear, and you see how they can phrase it differently. The second example is the same family, same spousal unit, number one spouse and the kids, they live in BC, and the number one spouse is not the owner of the property. The number two spouse spends most of their time outside the country, and 100% of this number two spouse's income is earned outside of Canada, and that is the owner of the home. In this situation, definitely, they're a satellite family because 100% of the income is earned outside, and none of it is being declared on a Canadian income tax return. So 0% would be declared as Canadian income. So when you get charged this SVT tax, foreign owners and satellite family peoples, when they get charged that 2% of the fair market value, they can claim a tax credit that's equal to 20% of their income earned in BC to reduce the 2% of the SVT owing. So if we go back to this example, 0% was being earned in Canada, so they wouldn't even be able to get this tax credit because it's 20% of any income earned in BC. And if you're not earning any income in BC, then you wouldn't be able to even get this tax credit. Okay, so exemptions. How do you get exempted from the SVT if it's your principal residence? So principal residence exempts you from quite a few things. We've already learned that. It has to be your full-time home and your principal residence for that calendar year for you to claim that exemption. There are some rental exemptions. So the property has to be occupied by a tenant for at least 6 months of the year, and it has to be in increments of 1 month or longer. So going back to what we were talking about previously about short-term rentals as opposed to long-term rentals, short-term rentals is anything that's less than 30 days. So that's what they're referring to here. The rentals need to be those long-term rentals, right? 1 month, 30 days or longer. And it has to be for at least 6 months out of the year, because then that means that it's being used as a principal residence by somebody 6 months out of the year. Even if it's different tenants, that's okay. It's still being used as a principal residence for those times. The rental exemption is respect of non-arm's length tenants. So there is one for non-arm's length. So this one would be arm's length, right? Business agreements. There is an exemption for non-arm's length tenants for your family members or friends, that kind of thing, so long the residence is that tenant's principal residence. The last one is major home renovations and life events. So for this one, there's major home renovations. Obviously, nobody can live in the property if you need to kick everybody out in order to do those renovations. So you would get an exemption based on that. And life events, major life events that happen. So death, divorce, bankruptcy. Some other ones are, just let me look here for you. Some other ones are if there's hazardous or damaged property. So if it's been deemed unfit for human habitation, for licensed daycares. And if you're stuck in hospital, then you get a medical absence, because if you're in hospital, then obviously you can't live in the property for those times and those weeks and months that you're in the hospital. So sometimes you can get those exemptions under those special circumstances as well, because you never know what life is going to throw at you. Okay, so make sure that you know this stuff. And if you want to get an exemption, you have to be a Canadian citizen, right, or a permanent resident, and you can't be part of a satellite family, right? So that satellite family would be in that other category, and they would be able to get that tax credit, provided that they earn some cash here in BC, and they can get 20% of it to go towards that SVT amount. So here we are at the last one, the empty home tax. Stick with me, we're almost done. I just want to take a moment again to say that the empty home tax is different than the SVT. Okay, they're not the same thing. Now, when we explained the information about the SVT, we said it was only applicable to certain taxable areas of BC. So it was a lot of different areas. It's a really long list. The empty home tax is for Vancouver only. Okay, so it applies only to Vancouver. Now, what does that mean when we talk about the SVT and the empty homes tax? If you own a property in the majority of the areas in Vancouver, you could actually be subject to both. So you could be charged the SVT and you could be charged the empty homes tax as well. What are you going to pay for this one? For the EHT, you pay 3% of the property's value if it's unoccupied for a full 6 months of the year or more. And this is meant to target investors that use their properties for those short-term rental periods, for the Airbnb, those rental periods are shorter than the 30 days. So the exemptions that you get for the EHT, that you can claim for the EHT, are very similar to the ones that we talked about for the SVT. And that's the reason why a lot of times you guys get them jumbled up. So for the properties that are rented for at least 30 days in a row, meaning those are long-term rentals, right? They're not the short-term rentals, and it has to be for 6 months, at least 6 months out of the year. So in aggregate means it's added up. It doesn't have to be 6 months in a row. It could be, rented for a month and lived in for a month, and rented for a month and then lived in for a month, and rented for a month and lived in for a month. So you just have to have it for 6 months or more in the year, and 30 days in a row or more for each of those rental periods. So that you would be allowed to claim an exemption and not pay the empty home tax. It doesn't apply to properties where it's being used as a principal residence by either the owner, a family member, or even a friend. So that is another exemption that you could claim and not pay the empty homes tax for this one. So again, remember, EHT applies to Vancouver only, and the SVT applies to a bunch of different taxable regions in BC, including a lot of the areas in Vancouver. So you could be subject to both if you own a property in Vancouver that is considered to be empty vacant. Okay, in which of the following scenarios would the City of Vancouver empty homes tax likely apply? The owner spends the summer from June to August living in the property as principal residence, and for the remainder of the year, she lists the property on Airbnb exclusively for weekend trips. She does not have a hotel or a B&B license. So because she's taking part in those Airbnb rentals, right, they're less than 30 days, they're considered short-term rentals, she is considered to have an empty home, and she's going to be subject to that empty homes tax. She'll likely be subject to the SVT, the speculation and vacancy tax, as well, which means that the other three can claim exemptions. They don't have to pay the empty homes tax because it wouldn't apply to them. So the owner lives abroad, but he rents the property for 6 30-day terms throughout the year in order to avoid paying the empty homes tax. The owner uses a property as a principal residence, but spends up to 6 months out of the year abroad on business trips. So for this one, it's kind of tricky. He spends up to 6 months of the year abroad, which implies that he's spending the other 6 months at home. So he's meeting the criteria of it being his principal residence for at least 6 months out of the year. 4 is the owners initially purchased the property as an investment, but now that their daughter has started attending university in Vancouver, she uses a property as a principal residence from September to April. So because she's spending September to April, right, that's 8 months out of the year, that isn't considered to be empty because there's only 4 other months out of the year that the property might sit empty. So there you go. That's it. Easy one. You're all done. Interesting. Review. Like, come back all the time. Make sure that you come back to go over information, especially for lists and details, that kind of thing. And make sure you get to those quizzes within a day or two is the best. Within a week, if you have to leave it that long. Okay? Make sure that you come back to review previous chapters. And if you haven't already done it for all the previous law chapters that we've done, you really need to get on reviewing those chapters before you forget that information that's in them. Okay? Thank you very much for joining me. I had fun. I hope you did too. And I will see you in the next video.